basic form. If you could look at where your premiums go each year, you're going to see something like this. If you wanted to draw out a whole life policy, you would see that you're paying premiums. You might recall from back in Module 3 that your premiums go to 3 different places. Some of your premium dollars are going to go to fund the mortality costs associated with the policy. In a whole life insurance policy, we refer to that as the net amount at risk. That's your mortality costs. Now, in the early days of your whole life policy, your mortality costs are going to represent the majority of your premium allocation. But there is some of your premium that's going to build an account value, what we would have called investments earlier. So those investments, or that policy reserve, which you'll remember from an earlier video, is actually owned by the insurance company. The insurance company looks at this policy reserve, though, and says, as the policy reserve accumulates, we don't have to have so much put away to fund the net amount at risk. So this grows. As the policy reserve grows, the requirement to fund the mortality costs decreases. Let's say that we had a $100,000 whole life policy. Well, it'll always be a $100,000 death benefit for as long as you own the policy. In the early days, the insurance company has to put away a fair bit in order to fund mortality costs. That is, if somebody dies, then it's actually going to be primarily insurance that ends up paying that $100,000 death benefit. But later on, let's say you die at a much later point in life, well, at this point, the insurance company's built up a significant policy reserve on your behalf. And now, at the time of death, they're going to use that policy reserve to fund that death benefit, which means very little has to be put away to fund that mortality costs. At the point at which we have a policy reserve that's sufficient to fund that death benefit for the rest of your life, the policy is considered to be paid up. It may not be an equivalent amount. It'll be the present value of that death benefit at the expected point of mortality. So if you have a paid to 65 policy, we might expect you to live to, say, age 82. The insurance company says at age 65, there has to be enough sitting here in order that we know by age 82, with some reasonable growth, it's going to hit $100,000. And keep in mind that the growth here is based on typically a guaranteed set of investments. Insurance companies are heavy purchasers of bonds, for example. Insurance companies acquire a lot of bonds because those bonds feature reasonably close to guaranteed growth. Now, there is a third factor when we're calculating premiums. You'll remember we talked about the investments, we talked about the mortality costs, but we also have the expenses of the insurance company. So this is a whole life insurance policy in its most basic form. Now, there are not a lot of options when you acquire a whole life policy. When you buy a whole life policy, really what you're going to decide, how much face value do I need? You're going to decide, and by the way, the face value would be based on the needs assessment. We did the needs analysis in a separate video. If you want to go back and review the needs analysis, I strongly recommend that you do so. It's an excellent video. It shows you how to answer some of the more difficult exam questions you're going to come across. We would have done a needs analysis, though, to determine how much insurance this family or business owner or whatever you happen to have needs. So that's the first thing to decide. And then, once we're deciding on the actual structure of a whole life insurance policy, We're going to look at what riders and benefits are appropriate. Now, we haven't talked about riders and benefits yet. We'll discuss that in a future video. We're going to look at whether the policy is going to be a participating or a non-participating policy. With a participating policy, the policy owner has the opportunity to participate or to enjoy the benefits of the insurance company doing a good job of managing their expenses, or the insurance company enjoying less claims experience than expected, or the insurance company doing very well on its investments. If you choose a non-participating policy, then you don't have the opportunity to take advantage of those good characteristics of the insurance policy. And the other choice that we can make, of course, is what's the premium structure going to look like? Am I going to have a 10-pay, a 20-pay, a pay-for-life, or a pay-to-65 policy? Now, going back to participating versus non-participating, how do we arrive at a participating policy then? Well, if I make the decision to acquire a participating policy, my premiums are going to be a little bit higher. It's going to cost me more to acquire a par policy than to acquire a non-par policy. And typically, that is the terminology we see attached to it. Almost nobody refers to participating or non-participating insurance. It's almost always referred to as